Hello and welcome to ZZ Financial. We're committed to bringing you the most accurate, valuable, and timely insights and analysis.
And welcome to the deep dive.
Now, it's Tuesday, August 26th, late night here, 10 p.m. Eastern Time or 7 p.m. out on the Pacific Coast. And as always, we're here to cut through the noise, take that stack of sources you've got, and really get to the heart of what's truly shaping the global financial landscape. Our mission today is to take all this information and really unearth those critical nuggets, those aha moments that make you truly well-informed. We've got a fascinating mix today, really, from high-stakes political drama right here in the U.S. to shifting trade routes and some surprising corporate moves happening around the globe, even touching on ethical investing. It's quite a spread.
Indeed. Today's deep dive is really a masterclass in market interconnectedness. It's fascinating. We'll be navigating the significant ripple effects of U.S. political decisions, specifically on central bank independence. We'll look at the ongoing economic resilience we're seeing, surprisingly perhaps, in the U.S. Then there's the growing political instability brewing in Europe. And we'll see how global trade, commodities, and yes, even ethical investing are all playing their part in this really complex financial story. You'll see how these seemingly separate events are actually strands in a much larger web.
Okay, let's unpack this. The biggest story dominating the headlines, and frankly, it's quite unsettling for a lot of people, is this unexpected political shakeup right here in the U.S. It seems to directly challenge, well, a core tenet of our financial system, the independence of the Federal Reserve. What's truly at stake here? What makes this specific action so unprecedented?
Right. What's truly fascinating and concerning to many is the direct, very public challenge to the Fed's independence. So on August 25th, President Trump announced via social media his intention to dismiss Fed Governor Cook. He even publicly disclosed the dismissal letter. Now, the alleged reasons given, according to government officials, were concerns about Cook's mortgage contract. Apparently, this prompted calls for an investigation.
I mean, so the president could just fire a Fed governor. I thought the Fed was supposed to be independent, like, a referee in a game, separate from the players.
Yeah. Well, that's precisely the core issue and why this is so significant. Legally, it's quite ambiguous. Governor Cook herself responded very quickly, denying the allegations and stating emphatically that, quote, Trump has no such authority and she intends to sue. The Federal Reserve itself issued a statement saying it will comply with court decisions. That clearly signals they expect a major legal battle. This isn't just politics, it's constitutional. And historically, this is absolutely unprecedented. It's the first time in the Fed's entire 110-year history that a president has attempted to dismiss a Fed governor. President Trump had, hinted before about dismissing Chair Powell, but actually targeting a specific governor and starting the formal dismissal process. That's a much more aggressive and legally murky step. The whole just cause requirement for dismissal in the Federal Reserve Act is now front and center. It creates this profound uncertainty about presidential power over the Fed. The key insight here isn't just if she gets dismissed, but how this challenge itself, this unprecedented move, fundamentally alters the bedrock of monetary policy. It potentially opens the door to a new era of, politicized economic decisions.
Wow, that context really underscores how profoundly serious this is. So what happened in the markets right after this news broke? Did investors panic, or was it more complicated?
The initial reaction, especially during Asian trading hours when the news first hit, was indeed notable, but also quite telling. We saw some immediate dollar selling. The Japanese yen strengthened a bit, trading around 146 yen per dollar. And there was definitely selling pressure on U.S. stock index futures. So a clear sort of knee-jerk negative reaction to the uncertainty.
Okay, so some initial jitters.
Exactly. But what's equally interesting is how quickly the market adjusted. When reports came out that Governor Cook refused to resign and planned to fight the dismissal legally, the market reversed course pretty fast. The dollar recovered, moving back towards 147.5 yen per dollar. This quick reversal tells us something important about how investors are thinking right now.
So the market dipped and then bounced back pretty quickly. Does that mean investors aren't really worried in the long run? Or are they just sort of waiting to see what happens? It feels like sometimes these big political announcements make a huge splash initially, and then the market just shrugs it off.
That's a very astute observation, and it really points to a kind of dual perspective among investors right now. On one hand, many market participants are, frankly, getting a bit tired of adjusting investment positions with every Trump statement. They've seen this pattern before, right? Aggressive announcements, often followed by either a walkback or a legal challenge. So there's a degree of skepticism that this dismissal will actually happen. For many, it's currently a lower priority compared to, say, NVIDIA's earnings coming up or the next inflation print. We saw prediction markets like Polymarket showing pretty low odds of Cook resigning only about 10% by September and less than 30% even by December.
Okay, so some are just tuning out the noise.
Sort of. But then, on the other hand, as economist Mohamed El-Arian pointed out, there are also investors who are very much in a wait-and-see mode. They recognize the legal uncertainty is real and potentially significant, so they prefer to hold off on making major moves until there's more clarity.
Makes sense. What about the bond market? Did that react differently?
Yes, the bond market reaction was particularly interesting and perhaps more telling. Long-term interest rates initially fell, and somewhat counterintuitively, stock indices actually rose after the initial dip. This meant we didn't see that triple decline, stocks, bonds, dollar falling together that we saw back in April when similar concerns about Fed independence flared up. But specifically, the yield on two-year bonds, which are very sensitive to expectations about Fed policy, fell quite significantly. This caused the yield curve to steepen. And that steepening reflects concerns that the Fed is losing its ability to curb inflation.
Okay, unpack that a bit. Why does the steepening yield curve signal worries about inflation control?
Right. So if the market believes the Fed might be pressured politically into cutting rates too soon or too aggressively, even if inflation isn't fully under control, then investors expect higher inflation down the road. To compensate for that expected future inflation, they demand higher yields on longer-term bonds relative to shorter-term ones. That's the steepening. So while the stock market might have brushed off the immediate political drama, the bond market is signaling a deeper, more structural concern about the Fed's future credibility and effectiveness against inflation.
That's a powerful distinction, the equity market's short-term shrug versus the bond market's longer-term worry. It brings us to the bigger question. If this dismissal is ultimately successful, what could that mean for the Fed in the long run? We hear this phrase, the Trumpification of the Fed. What does that actually mean for everyone listening, for their savings or their job prospects?
If Governor Cook's dismissal is ultimately successful, yes, the long-term consequences could be quite profound. It clearly opens the door for President Trump to appoint a new governor, presumably one who aligns more closely with his preference for lower interest rates. This would undeniably shift the balance on the Federal Open Market Committee, the FOMC, which is the body that actually sets U.S. monetary policy. It would tilt it towards a more dovish stance, meaning more inclined to favor rate cuts. And to understand the potential full impact, you have to look at the board's composition. You've got Governors Bowman and Waller, who were appointed during Trump's first term. Then Milan is set to replace Kugler, who resigned midterm just this month. So if Cook is replaced by another Trump appointee, that would mean Trump-appointed governors hold 4 out of the 7 seats on the Board of Governors.
4 out of 7. That's a clear majority. What exactly could that majority do? What would that mean for, regular people listening, for their savings accounts, their job prospects, the wider economy?
Absolutely. It could have significant ripple effects across the economy, potentially impacting everyone. Such a majority on the Board of Governors could, for instance, exert considerable influence over the reappointment of the regional Fed presidents. Like Chicago Fed President Goolsbee, his term is up in February next year. As Krishna Guha over at Evercore ISI pointed out, this process could further accelerate what he termed the Trumpification of the Fed. It's not just the board members, but potentially the regional presidents, too, over time.
So a more politically influenced Fed, how would that translate into policy?
In terms of monetary policy, a more dovish, rate-cut-friendly Fed would likely put downward pressure on U.S. Treasury yields, particularly at the shorter end. It could also lead to a weaker dollar, which, affects everything from the price of imported goods to the competitiveness of U.S. exports. Equity markets might actually see sustained rises if the underlying economic conditions remain solid. But there's a big but here.
Uh-oh. What's a but?
The but is inflation. If policies become too loose, driven by political desire rather than economic data, it could very easily reignite inflation fears, as Sam Stovall from CFRA warned. That's the major risk. And President Trump has been quite explicit about his goal. He reportedly stated, "We will soon have a majority. It's fantastic."
Right.
This really suggests a direct intention to overhaul the Fed and perhaps temporarily deprive it of its crucial forward guidance function, its ability to signal future policy intentions clearly, as Jamie Cox at Harris Financial Group noted.
So the Fed might become less predictable.
Potentially, yes. The broader concern, even if markets are shrugging it off for now, is this frequent disregard for central bank independence. This kind of erosion of institutional trust can have really long-lasting negative effects on how markets perceive the predictability and stability of economic policy. It raises fundamental questions about the balance of power, the role of independent institutions. The long-term implication for you, the listener, is a potentially more volatile interest rate environment and a Fed that might be seen, rightly or wrongly, as less effective in managing inflation or recession, depending on which way the political winds are blowing.
That's a really comprehensive look at the potential fallout. But, okay, despite all this political drama swirling around the Fed, the U.S. stock market actually seemed pretty resilient today. How did it manage to rebound, and what's that telling us about the underlying economy?
It's true. The resilience was quite remarkable amidst all that noise.
Huh.
On August 26th, the Dow Jones Industrial Average did rebound, closing up 0.29%, settling just over $45,400. The Nasdaq Composite also had a healthy gain, up 0.44%. And this rebound was primarily supported by a string of surprisingly resilient U.S. economic indicators, particularly the July durable goods orders and the August consumer confidence figures. They generally came in better than the market was expecting.
Okay, so the economy seems to be just chugging along, almost ignoring these political headwinds. What specific numbers are really showing this resilience? What's telling us things are basically okay underneath it all?
Excellent question. Let's dig into those specifics because they are quite revealing. For July, durable goods orders fell by 2.8% month on month. Now, a fall sounds negative, right?
Yeah.
But this was actually not as steep as the market forecast, which was for a 4.0% decline, so better than feared. And crucially, if you strip out the volatile transportation sector, think aircraft orders and such orders actually rose by a healthy 1.1%. That suggests core business investment remains pretty robust.
Okay, that's a key detail. What else?
Then there's the Consumer Confidence Index for August. It came in at 97.4. Now, that was a slight worsening from the revised number for the previous month, but it still exceeded market expectations, which were around 96.5. It indicates that consumers, despite inflation and other headwinds, are not as pessimistic as analysts had feared.
Still reasonably confident then.
Reasonably, yes. And we also saw other data points adding to this picture. The S&P Case-Shiller Home Price Index was up 1.9% year-on-year in June. Existing home sales rose 2.0% in July. So all these figures, taken together, paint a picture of an economy that is indeed, as you said, chugging along, demonstrating a surprising degree of resilience. While the Fed independence concerns did cause the Dow to dip by about $90 at one point during the day, the selling did not persist. It shows that this underlying economic strength provided a sort of floor for the market.
It's fascinating how the market can sometimes compartmentalize these issues, looking past the political drama to the economic fundamentals. Now, let's zoom in on some individual companies. We saw some standout corporate stories today that reveal specific industry shifts or just interesting developments. What caught your eye?
Yeah, there were some really interesting individual company stories that definitely highlight broader shifts and opportunities. For instance, Eli Lilly surged, up an impressive 4.8%. This was after they announced positive phase 3 clinical trial results for their oral obesity drug candidate, orforglipron.
Oral, not injectable.
Exactly, an oral option. The drug showed significant weight loss and also reduced blood sugar in adults with type 2 diabetes over 72 weeks. This wasn't just a win for Lilly. It really reassured the market after some previous concerns about a trial for non-diabetic adults. It just underscores the massive growing potential in the obesity treatment market. Lilly plans global regulatory submissions this year.
Huge market potential there. What else?
Okay, in aerospace, Boeing was a standout performer today, rising significantly. This boosted the Dow. The trigger was news of a large order for over 100 aircraft from Korean Air. It shows that cyclical recovery, but also the enduring demand in the aerospace industry, especially for the big players. Then, look at the defense sector. Lockheed Martin rose 1.9%. This came on speculation that the Trump administration is considering acquiring shares of U.S. defense-related companies.
Acquiring shares, like the government buying stock in defense contractors.
Yeah, that's the speculation. Commerce Secretary Ratnick seemed to confirm this thinking, noting that such companies are, quote, essentially like a part of the U.S. government. Other defense firms like RTX and General Dynamics also saw gains on this news.
Interesting dynamic. What about tech?
Right, tech saw some interesting moves too. AMD, Advanced Micro Devices, rebounded 1.9%. This followed an upgrade from Truist Securities to buy with a raised target price. Analysts there noted a really interesting shift. Hyperscalers, the huge cloud providers, seem to be moving from viewing AMD primarily as a bargaining chip against NVIDIA to seeing them as more of a collaboration partner. There's apparently genuine interest in large-scale deployment of AMD's AI semiconductors. Truist now expects AMD to capture maybe 10% of the data center GPU market. That's significant.
A real competitor emerging then.
Potentially, yes. And speaking of AI's impact, look at software. Okta, the identity management company, surged 7% in after-hours trading. They raised their full-year sales and EPS forecasts. Why? Strong subscription growth and expanding demand for security management, which is being driven in part by AI adoption.
Ah, the security angle of AI.
Exactly. And even more dramatically, MongoDB, the database company, surged an incredible 28% in after-hours trading.
28%.
28%. They significantly raised their full-year outlook for both revenue and EPS. Again, citing AI-related software demand and strong performance from their Atlas Cloud database. So these aren't just isolated successes. They really demonstrate that demand for AI infrastructure, hardware, software, security remains a powerful growth driver, even with broader market anxieties.
Okay, what about some others? Any interesting retail or consumer stories?
Yeah, Canada Goose, the luxury outerwear maker, was up a strong 9.8%. Baird upgraded its rating to buy. They cited strong direct-to-consumer sales, up nearly 15% year-over-year in their fiscal Q1 2025. They expect profit expansion, especially heading into the key autumn-winter season, with a projected gross margin over 70%. Interestingly, they think marketing efforts in China will help offset declines elsewhere.
Resilient luxury demand, maybe?
Seems like it for some brands. Of course, not everything was up. We saw some declines in names like Chevron, Johnson & Johnson, Home Depot, Apple, Microsoft, Salesforce, United Health. So it was a mixed picture overall.
Got it. That's a great roundup, showing innovation pushing forward even with those macro uncertainties. Speaking of tech, the elephant in the room, as you mentioned, NVIDIA. It always feels like the pulse of the AI world. Their earnings are imminent, right? What are the expectations this time, and why is this such a huge deal for everyone, not just tech investors?
You're absolutely right. NVIDIA's earnings announcement is a monumental event for the entire market, not just the tech sector. It's really seen as a bellwether for the whole AI build-out. The announcement is scheduled for the afternoon of August 27th Eastern Time. And anticipation is, well, incredibly high. Forecasts are predicting a staggering 53% revenue rise to $46 billion and a 45% net profit increase to $24.5 billion. That's for the May-July 2025 period. Daniel Ives at Wedbush Securities, a prominent tech analyst, even suggests the market might still be underestimating the true scale of AI demand.
Wow, those are astronomical numbers. So a guaranteed stock pop then.
Oh, well, that's the tricky part. Despite these exceptionally strong forecasts, there's a significant hurdle, as analysts call it, for NVIDIA's stock. Market expectations are so elevated that a straightforward stock rally isn't guaranteed. We've seen this pattern before, actually. Past trends show mixed reactions even to record-breaking earnings. Sometimes the stock dips in after hours or the next day due to profit-taking or because the whisper number wasn't beaten by enough. The impact on broader markets has also sometimes weakened after the initial reaction.
So beating estimates might not even be enough. What are the specific worries?
Exactly. Beating might not be enough. They probably need to crush estimates and offer very strong guidance. Key concerns include the ongoing U.S. China trade tensions. Management's comments on exports to China will be absolutely crucial, specifically regarding their H20 chip, which faces restrictions and potential exclusion by Chinese authorities. Any cautious remarks here, any hint of slowing demand or access issues in China could easily trigger selling.
The China factor is huge.
Huge. And then there's just the simple risk of profit-taking. The stock has had an incredible run. Even record earnings have sometimes led to after-hours dips and next-day market declines simply because investors decide to lock in gains. So the bottom line, emphasized by analysts, is unless results exceed expectations with surprises, meaning they don't just meet but comfortably beat those high forecasts and offer strong forward guidance, semiconductor stocks may not rally. This cautious mood ahead of NVIDIA is definitely leading to somewhat low trading volume and a wait-and-see stance for many major stocks globally, including related stocks in places like Japan. Everyone's holding their breath.
That certainly paints a picture of intense focus on one company, shaping broader market sentiment. Okay, this political turbulence impacting the Fed naturally raises questions about stability not just here but globally. And if we look across the Atlantic, Europe is grappling with its own significant political shifts. What's happening in France, and how is that impacting the euro and European markets?
Yes, the political situation in France is definitely causing concern and contributing to market volatility over there. The core issue revolves around Prime Minister Bayrou's announcement on August 25th. He confirmed a cabinet confidence vote will be held in the National Assembly, France's lower house, on September 8th.
A confidence vote. That sounds serious. What's the risk of defeat for the French government, and how is it impacting the euro?
It is serious. Given that France has a minority government, the ruling party doesn't have an outright majority in the lower house. This isn't just political theater, it's a high-stakes moment. The risk of defeat for the Bayer cabinet is considered very high by market observers, like Germany's Berenberg Bank. Opposition parties have already indicated they will not support the government in this vote, making a no-confidence outcome seem highly likely.
And the market reaction?
Immediate and negative. This political uncertainty sent ripples through the markets. The euro fell against the dollar, slipping towards the 1.165060 level, and it also weakened slightly against the yen. We saw euro selling and dollar buying emerge for position adjustment, especially after some weekend speculation about potential U.S. rate cuts faded. French government bonds also felt the heat. Yields rose, hitting their highest level since March, around 3.53% for the 10-year bond. Crucially, the difference between French 10-year yields and German 10-year yields, which are seen as the benchmark safe asset in Europe, widened significantly to around zero point 0.8 percentage points. That's the largest gap since April.
Wider spread means more perceived risk in France, right?
Exactly. It's a clear sign of investor nervousness. And that spread is even approaching an inversion with Italy's 10-year yield, which is quite unusual and signals significant stress. French stocks also took a hit. The main CAC 40 index dropped 1.69% to a two-week low. Financial stocks were particularly hard hit. Société Générale down 6.8%. BNP Paribas temporarily plummeted 7.9%. Luxury sector stocks also suffered.
Wow, big moves. Are there deeper fiscal worries behind this too?
Absolutely. The political instability feeds directly into fiscal concerns. French Finance Minister Lombard issued a pretty stark warning. He stated that IMF intervention is possible if crucial fiscal reforms fail because the cabinet collapses. He added, "I cannot say this risk does not exist." That's a serious statement, pointing to unresolved fundamental fiscal reconstruction challenges France faces.
But what happens if the government does lose the vote?
That's the political dilemma. If Bayrou's administration collapses, President Macron would have to appoint a new prime minister. But without a clear majority in parliament, as Raphael Brunemagir at JP Morgan noted, another potentially weak government could emerge, just perpetuating the uncertainty. Macron seems cautious about dissolving parliament and calling another general election, likely fearing an even worse outcome. So the prevailing market view right now seems to be, as analysts suggest, adopting a bearish stance on French financial assets simply because there's no clear path to fiscal stability in sight. It's definitely a situation to watch very closely, impacting not just France, but the stability of the broader Eurozone.
That's a significant amount of economic and political instability packed into one country. And it makes me think about global trade, which is always tangled up in these shifts. We're seeing a fascinating, almost counterintuitive story emerging with Asia-Europe shipping. Record high volumes, but freight rates are falling. What's driving this apparent contradiction, especially when we keep hearing about slowing global economies?
It truly is an intriguing paradox, isn't it? A real head-scratcher at first glance. The headline number is indeed striking. Maritime container shipping volume from Asia to Europe hit a record high in the first half of 2025. That's January through June. The volume surged 8.9% compared to the same period last year, reaching an astounding 9.57 million TEUs. Those are the standard 20-foot equivalent container units. It's a new record for a half-year period.
A record high in shipping. That sounds like booming trade. So what's driving this, especially if European economies aren't exactly booming?
Right, that's the key question. The primary driver, even with those slowing global economies, appears to be China's concerted export offensive aimed squarely at Europe. Amid the intensifying U.S. China trade friction, China is actively seeking alternative destinations for its goods. Shipments from China to the U.S. had actually stagnated, falling for 3 consecutive months from May to July, so China needed to pivot.
So it's a redirection of trade flows.
Precisely. Nearly 80%, almost 4/5 of this record Asia to Europe volume, originated from Greater China. That's mainland China and Hong Kong combined. Shipments just from that region grew by a robust 9.7% year-on-year. And this offensive is broad-based. It's boosting exports of a wide range of items, everything from electrical equipment to furniture.
And this is directly linked to the U.S. China trade issues.
Yes, the connection is quite clear. As Professor Takuma Matsuda from Kanagawa University explained, the increased U.S. tariffs on Chinese goods implemented by the Trump administration definitely dampened China-U.S. trade. This essentially forced China to try and offset those reduced exports to the U.S. by significantly increasing shipments to other markets, primarily Europe and also Southeast Asia. So it's a vivid illustration of how geopolitical forces are actively reshaping global supply chains in real time.
Okay, so record volume driven by China's pivot. But why are the rates falling then? Shouldn't higher demand mean higher prices?
That's the other side of the paradox. The outlook isn't entirely rosy, despite the volume. Firstly, the European economy itself lacks momentum, as reports note. Underlying demand for consumer goods there is actually quite weak. While Germany's planned fiscal stimulus could help a bit, Europe is also simultaneously promoting de-risking strategies. They want to reduce their supply chain dependency on China. This creates significant uncertainty about future cargo movement.
So demand might not stay this strong.
It's uncertain, but the more immediate reason for falling freight rates, despite the record volume, is ship supply. Freight rates for spot container shipping immediate bookings from China to Europe have shifted to a downward trend. They're currently around $1,668 per TEU. This is largely due to a surplus of ships. There's been a wave of new, large container vessel deliveries hitting the water since 2024. Plus, some ships that were previously on U.S. routes have been redirected to Asia-Europe after a temporary U.S. tariff suspension expired, adding capacity there.
So too many ships chasing the cargo, even if there's a lot of cargo.
Exactly. It's a classic supply-demand imbalance, but on the supply side this time, the entire situation really emphasizes how sensitive container shipping is, how it's swayed by tariff policies, and these broader global geopolitical shifts. It creates a very fragile equilibrium.
That's an incredible illustration of how interconnected global forces are, even creating seemingly contradictory outcomes like record volume but falling rates. Now let's talk commodities, specifically crude oil. Oil prices have been on a bit of a slippery slope, haven't they, despite all the geopolitical noise we constantly hear. What's behind this downward trend?
Indeed, the trend for crude oil has been notably weak, perhaps surprisingly so given the headlines. North Sea Brent crude futures, the international benchmark, were trading around $68 per barrel on August 25th. That's nearly 10% lower than where it ended last year. And market expectations are generally for it to weaken further, potentially towards $60 per barrel by the end of 2025.
Oil prices dropping to $60. That sounds good for consumers at the pump, but why is this happening when we still hear constantly about geopolitical risks in the Middle East, Russia, everywhere? You'd think with all those tensions, prices would be going up, not down.
It's a very valid question, and it highlights the difference between headline risks and underlying market fundamentals right now. What's fascinating here is that the core reason driving this downward trend is actually a persistent oversupply in the market. Simply put, global oil production growth is outpacing the growth in demand.
Oversupply, even with OPEC plus cutting production.
Yes. While it's true that OPEC plus countries have implemented voluntary production cuts about 2.2 million barrels per day, those specific voluntary cuts are scheduled to end in September. And there's a high likelihood, analysts believe, that further reductions in their coordinated cuts will also follow as they try to manage the market. But offsetting that, non-OPEC plus countries are increasing production significantly. Think the U.S., Canada, Guyana. They are steadily increasing their crude oil output. And this is steadily eroding OPEC plus market share and adding barrels to the global supply, tipping the balance towards oversupply.
So non-OPEC is basically filling the gap.
Largely, yes. Now, the geopolitical risks you mentioned absolutely do exist. They create volatility. Hints from the Trump administration about potentially strengthening sanctions against Iran and Russia could offer some short-term support to prices, particularly if countries like China and India get nervous about U.S. secondary sanctions and reduce their purchases. And, of course, Ukraine's ongoing attacks on Russian refineries could also lead to localized supply disruptions, adding a risk premium at times.
But these aren't enough to push prices sustainably higher.
Apparently not, according to the current market consensus. The thinking is that the upside for oil prices is quite limited for two main reasons. First, OPEC Plus still holds significant spare production capacity. That means if there is a major disruption somewhere, they have the ability to relatively quickly increase their own production to compensate, preventing a sustained price spike. Second, and perhaps more importantly in the current context, President Trump has a very clear political objective. He wants to avoid inflation caused by high gasoline prices, especially leading into an election year or during his term. This makes it seem unlikely that his administration would take sustained measures that would deliberately lead to significantly higher oil prices. Geopolitical price spikes are therefore generally seen by the market as likely to be temporary.
Okay, that makes sense. Politics cutting both ways there. What about this news on U.S. tariffs on India buying Russian oil? How does that fit in?
Right, that's another piece of the geopolitical puzzle influencing the oil market. The U.S. government is reportedly set to impose a 25% additional tariff on India, specifically for its purchases of Russian crude oil starting on the 27th. This is part of the broader strategy of sanctions against Russia. This move could impact global crude oil supply and demand dynamics. If India cuts back on Russian crude, where does it buy from instead? Where does that Russian crude go? It could lead to some selling in the market for position adjustments as traders figure out the implications. So, while geopolitical events definitely create volatility and require adjustments, the fundamental story for oil right now seems to be dominated by that supply-demand imbalance, coupled with a political desire, at least from the U.S. side, to keep prices from running away.
Okay, so oil prices down, partly due to oversupply and maybe political aims, but overall geopolitical risk is definitely up. That usually sends investors looking for a safe haven. And speaking of safe havens, I saw gold prices ticked up today. Is this rebound directly linked to that Fed independence issue we kicked things off with?
Yes, absolutely. The rebound in gold futures today is very much connected to those heightened concerns surrounding the Federal Reserve's independence. New York gold futures saw a decent rebound on August 26th. The December contract closed up about 0.5%, settling at $3,433 per troy ounce. And reports indicated that buying flowed into gold futures precisely due to concerns over the FRB's compromise independence.
So the logic is, if the Fed might be pressured politically, gold looks safer.
Exactly. If the market perceives that the Fed might lose some of its ability to effectively curb inflation because of political pressure, maybe pressure to cut rates too much or too soon, then gold becomes an incredibly attractive alternative asset. It's traditionally seen as a safe store of value, something that holds its value or even increases during times of economic and political uncertainty. This is especially true when fears of currency devaluation or rising inflation start to creep in. In essence, gold is acting as a hedge against the potential for an overly politicized and therefore potentially less effective central bank. The market is seeking security where it feels the traditional pillars of financial stability might be wavering just a bit.
That makes perfect sense.
Yeah.
Gold acting as a barometer of institutional trust, in a way. Now, let's pivot across the Pacific and get some insights from Japan. We're seeing a really interesting, almost contradictory situation there, which has been dubbed the stock boom recession. The Nikkei stock average hit a record high recently, but domestically, people are saying the economy feels, well, poor. What on earth is going on there?
It is a truly fascinating and somewhat perplexing situation, yes. Economist Koichi Fujishiro aptly termed it the stock boom recession, and that captures the paradox perfectly. On the one hand, the Nikkei stock average did indeed hit a record high, reaching 43,714 yen back on August 18th. This was driven by a combination of factors. Expectations of U.S. rate cuts certainly helped, but also genuinely strong corporate earnings from many large Japanese companies. Yet on the other hand, domestic economic sentiment within Japan remains stubbornly poor. This is largely due to prolonged high prices and negative real wages. Wages aren't keeping up with inflation. This is visibly weakening personal consumption, and that disconnect is the heart of this stock boom recession.
That really is a head scratcher. How can stocks be booming when people on the street feel like they're in a recession? There must be some hidden factors creating such a big gap between the market and the mood.
There are several hidden or perhaps less obvious factors at play here. They largely stem from how corporate earnings are measured and reported versus how the domestic economy is measured and felt. Firstly, many major Japanese companies, particularly those listed on the Nikkei, report their earnings on a consolidated basis. This means their reported profits include the performance of all their overseas subsidiaries around the world.
Ah, so it's not just their Japanese operations.
Exactly. GDP, on the other hand, is a domestic-only measure. It only captures economic activity within Japan's borders. Since many big Nikkei components are global corporations earning a substantial portion of their profits abroad, there's a natural gap between their strong corporate performance, and thus their stock prices, and what's happening within Japan's domestic economy.
Okay, that explains part of it. What else?
Secondly, there's the distinction between nominal and real GDP. When we talk about economic growth, the focus is often on real GDP, which measures the actual quantity of goods and services produced, adjusted for inflation. But for stock market correlations, nominal GDP, which includes price increases as part of the total value, is actually more relevant. Corporate profits, which are the bedrock of stock valuations, are inherently nominal figures.
So inflation can actually boost stock prices, even if the real economy isn't growing much.
Precisely. Even if a company's sales volume is flat, inflation increases the nominal value of those sales, which can boost nominal earnings and consequently support stock prices. Japan's nominal GDP actually grew at a pretty strong annualized rate of 5.1% in the second quarter of 2025. And that nominal growth helps explain some of the stock market buoyancy.
And the weak yen, how does
Oh,
that
yeah.
play into this?
The yen's weakness is another critical factor, but it cuts both ways, exacerbating the disconnect. For Japanese exporters, a weak yen is generally great news. It boosts their yen-denominated profits when they convert their overseas earnings back home, which directly lifts their stock prices.
Good for big companies.
Right. But for consumers, it's the opposite. A weak yen raises import prices for everything from energy to food, directly reducing purchasing power and reinforcing that feeling of being in a recession.
So it helps the stock market, but hurts the average person.
That's a big part of it. And what makes it worse is that relatively few Japanese households, compared to, say, the U.S., hold significant financial assets like stocks, which tend to be more resilient to inflation. This makes households feel vulnerable under inflation. The benefits from stock market gains and dividends spread slowly and unevenly through the population, while the pain of inflation hits everyone quickly and dampens sentiment easily. Historically, in deflationary Japan, holding cash was actually the rational thing to do. Post-bubble, stocks were often seen as inherently risky. The idea of stocks as an inflation-resistant asset hasn't really permeated the broader public consciousness yet.
But that could change.
It could. If inflation persists, this mindset might start to shift, potentially encouraging more stock ownership as a way to hedge against rising prices. Looking ahead, some analysts see the Nikkei potentially rising further, maybe towards 45,000 yen within the next 12 months. This would be supported by factors like high levels of corporate share buybacks and continued nominal GDP expansion. Plus, Japanese long-term interest rates, while rising, are still historically low, around 1.6%, currently providing a generally supportive monetary environment.
That's a fascinating and complex picture in Japan. Now let's zoom in on some specific corporate highlights from Japan. What were some of the key developments today that illustrate these broader trends or just stand out?
Sure, we saw quite a few interesting individual company movements in Japan today. For example, OG Material, a major paper company, announced plans for a significant price hike, more than 10%, for cardboard base paper starting in October. They cited rising labor costs, partly due to new logistics regulations affecting driver overtime, and also persistently high waste paper prices. This follows another sort of atypical price hike they made just back in spring 2024.
So inflation pressures hitting basic materials.
Exactly. They're aiming for an 8% return on equity, but they face challenges like falling domestic demand due to population decline and efforts towards simpler packaging. So their ability to actually make these price increases stick to pass costs through is seen as a future test. It's a micro example of those broader inflationary pressures we discussed. On a different note, Mitsubishi Corp, the huge trading house, saw its stock show only minor movement. This was despite reports that it might withdraw from 3 offshore wind power projects it was developing with Chubu Electric.
Why withdraw?
Apparently due to unprofitability. They likely bid too low initially and now face high material costs. They had already recorded a significant impairment loss on these projects, about $52.4 billion. So the market reaction was muted because this was likely anticipated. Then there's Nissan Motor. Its stock fluctuated and ended down about 2.14%. This came as the company confirmed it's ending production of its iconic GTR sports car.
The GTR. Wow. End of an era. Why?
They cited challenges with regulations and sourcing parts for future models. They hinted at a possible future revival, maybe electric, but acknowledged their business options are narrowing for that kind of vehicle. Earlier reports that Mercedes-Benz might be selling its stake in Nissan also likely weighed on the stock.
Okay, what else? Any positive stories?
Yes, definitely. Suzuki announced it's beginning shipments of its first electric vehicle EV model in India, with plans to export it to over 100 countries eventually. That's a significant step for them into the global EV market, leveraging their strength in India. On the quirkier side, McDonald's Japan saw its stock decline. Why? They had to postpone the launch of a popular cinema roll-themed Happy Meal set, pushing it back to September 12th.
Why postpone a Happy Meal?
Apparently to combat resellers. They faced similar issues with wildly popular Pokemon and One Piece themed sets recently, where scalpers bought them all up instantly. This postponement seems to have triggered some profit taking in the stock,
Resellers hitting McDonald's stock. Interesting.
isn't it? Then we saw some big jumps in smaller cap names. NJS, which is a water and sewage consulting firm, saw its stock surge over 15% to an all-time high. They significantly upwardly revised their net profit forecast for fiscal 2025, citing strong domestic performance and a robust pipeline of projects. There's also expectation around their use of drones for infrastructure inspections, shows strength in specialized infrastructure services.
Good niche to be in.
Seems so. Similarly, Makaki, a crowdfunding platform, saw its stock continue a sharp rise, up almost 16% today. They also upwardly revised their forecast, now expecting a profit of $360 million for the current term, flipping from a prior loss forecast. Sales were up 23%. They attributed it to improved project unit prices and growth in their advertising services. Highlights vitality in the digital economy and innovative financing. And speaking of finance, Monex Group, an online brokerage, surged over 14%. This followed reports that it plans to issue yen-pegged stablecoins domestically.
Stablecoins in Japan, like crypto.
Exactly. Yen-pegged stablecoins, likely backed by assets like Japanese government bonds. They're also reportedly considering acquiring a European crypto firm. Japan's financial services agency might approve stablecoin issuance as early as this autumn, so Monex is positioning itself for that potential growth.
Lots and diverse activity then. Any tech or pharma news?
Yes. On the downside, Hamatsu Photonics saw its stock decline after SBI Securities lowered its target price and earnings forecast for the next few years. They cited concerns about U.S. government budget cuts impacting bioresearch, which affects sales of medical equipment, and also intensified competition in China. But on the positive side, in pharma, Chugai Pharmaceutical rose 6%. This was linked back to that positive Phase 3 trial result for orforglipron, the oral obesity drug developed with Eli Lilly, which we discussed earlier. Chugai is Lilly's partner in Japan. The positive results in diabetic obese adults met all endpoints, contrasting with some earlier mixed results, boosting Chugai's shares as well.
The Lilly connection again.
Right. And finally, just a quick note, Apple announced its big event is set for September 10th, where they're widely expected to unveil the iPhone 17, always a market mover.
Okay, that's a whirlwind tour of Japanese corporate news. Before we leave Japan, you mentioned the bond market briefly. Long-term rates hitting 17-year highs and something about primary dealers and auctions. Can you elaborate on that? It sounds important for how interest rates are set.
Yes, definitely worth touching on. Japanese long-term interest rates did indeed reach their highest levels in about 17 years, hovering around 1.620% for the 10-year government bond. This rise is largely driven by expectations around the Bank of Japan's ongoing policy normalization, slowly moving away from decades of ultra-loose policy. But concerns over Fed independence in the U.S. and the resilient U.S. data we discussed also play a role influencing global bond movements.
Right. Now, these government bond auctions sound a bit technical, but they affect all our interest rates ultimately, don't they? Who actually buys these huge amounts of bonds? And why are the auctions themselves so important?
You're absolutely right. Government bonds might sound technical, but their yields really form the bedrock for almost all other interest rates in an economy, influencing everything from mortgages to corporate loans. So understanding how they're issued and priced is crucial. These government bond auctions are incredibly important because they represent the largest supply-demand event for market participants. It's where the Ministry of Finance issues a massive volume of bonds all at once to fund the government. This process directly impacts the level of long-term interest rates and bond yields across the board.
Okay, so who steps up to buy these massive amounts? It can't just be small investors.
No, definitely not. The key players who ensure these bonds are consistently bought, especially in Japan, are known as primary dealers, or PDs. Japan introduced this primary dealer system, the PD system, back in 2004. Its specific goals were to promote the stable absorption of the massive amounts of government bonds being issued, and also to help maintain market liquidity. Currently, there are 19 companies designated as PDs in Japan. These are typically major domestic and international banks and securities firms.
And what do these primary dealers have to do?
They have significant obligations. In all government bond auctions, they must collectively bid enough to meet the total planned issuance amount. And they also have an obligation to actually win a certain minimum percentage of that issuance over time. This obligation ensures stable absorption, meaning the government can always sell its debt and maintains market liquidity. Crucially, it prevents what's known as bid failures, where there aren't enough bids received to sell all the bonds the government needs to issue. That would be a major problem.
So they have to buy. What's in it for them?
Good question. In return for taking on these obligations, the PDs receive certain incentives. They get enhanced access, allowing them to directly exchange information with the Ministry of Finance about debt management policy. They also gain an enhanced presence in the market, which helps attract customer transactions in the secondary market. It's a status symbol, too. And alongside the PDs, the Bank of Japan also plays a role. It continues its regular government bond purchase operations across various maturities to help manage yields and ensure market stability, conducting operations today, for instance, across 5 different maturity categories. So these auctions are part of a carefully managed system involving both private institutions and the central bank, ensuring the government can fund itself smoothly while also setting those fundamental interest rate benchmarks for the entire economy.
That's a really clear explanation. It sounds like a sophisticated, almost invisible system that keeps things stable behind the scenes. Okay, for our final deep dive topic today, we're looking at something that goes beyond pure financials and touches on ethics. The ethical compass in global investments. Norway's government pension fund, which is one of the world's largest funds, made a truly impactful decision regarding the U.S. company Caterpillar. This fund selling off a major company like Caterpillar seems huge. What was the specific ethical concern that triggered such a big move?
Yes, this is indeed a highly impactful and, frankly, precedent-setting move in the world of responsible investing. Norway's government pension fund Global, often called the Norwegian Sovereign Wealth Fund, revealed on August 26th that it has excluded U.S. construction machinery manufacturer Caterpillar from its investment portfolio and sold its shares.
Excluded and sold. Wow, why Caterpillar specifically?
The specific ethical concern cited by the fund is grave. It relates to how Caterpillar's bulldozers are allegedly being used by Israeli authorities for the illegal destruction of Palestinian property in the occupied territories. The fund's Independent Council on Ethics had previously compiled a recommendation back in July. They concluded that, quote, "There's no doubt that Caterpillar's products are being used for systematic violations related to the demolition of homes and infrastructure."
So it's about how the products are being used, even though Caterpillar is a U.S. company.
Exactly, and that's what makes this particularly significant. This is reportedly the first case where the Norwegian fund has withdrawn funds from a company based outside of Israel, specifically over the Palestinian issue, due to the use of its products. The fund also disclosed at the same time that it had sold its shares in 5 Israeli banks due to their activities related to settlements in the West Bank. But the Caterpillar decision extends the principle to an international supplier.
That feels like a major step, widening the scope of their ethical screening. Was this an easy decision for the fund?
Almost certainly not. This decision wasn't made lightly. The fund, by its nature, invests globally across thousands of companies. It has historically been quite resistant to incorporating specific political judgments into its investment strategies, trying to remain neutral. However, it faces growing public and political pressure within Norway, especially with parliamentary elections approaching on September 8th. There have been increasing calls, particularly from opposition parties, for the fund to withdraw from Israel-related investments altogether. Nikolai Tengen, the CEO of Norges Bank Investment Management, which manages the fund, himself acknowledged the weight of the situation, stating, quote, "This is a serious situation concerning the fund's trust."
So it's about maintaining public trust and responding to societal values.
It seems to be a major factor. This powerfully demonstrates the increasing pressure that large institutional investors, especially sovereign wealth funds and public pension funds, are facing. They're being pushed to align their massive portfolios not just with financial returns, but also with broader ethical considerations, international law, and global humanitarian issues. It's a really significant marker of a shifting landscape in responsible investing, forcing both companies and the funds that invest in them to think much harder about their broader societal impact and potential complicity in controversial situations.
That is a truly thought-provoking development, with potentially huge implications for how global capital flows and where companies feel pressure. Wow. Okay, pulling it all together. Today, we've truly seen just how interconnected global finance is, haven't we? The political drama in Washington over Fed independence, the surprisingly resilient economic indicators here, the shifting sands of European politics in France, even the ethical choices of a huge pension fund halfway across the world, they all create these ripples, impacting everything from the value of the euro to the price of crude oil, maybe even the price of your next cardboard box delivery. It's a constant dance between the expected and the surprising.
Indeed. It's a testament, really, to the complex web of forces that shape our financial world. Each piece of news, whether it's a presidential tweet, a corporate earnings report, or a central bank decision, contributes to this larger narrative. It really demands a holistic understanding, doesn't it? You can't look at any one piece in isolation.
Absolutely. And here's where it gets really interesting, I think, looking forward. If central bank independence truly does become more of a political football, as seems possible, and if huge pools of capital like sovereign wealth funds start making major investment decisions based more explicitly on human rights concerns, how does that fundamentally change the rules of the game for everyone trying to understand and navigate these markets? What stands out to you, the listener, about the long-term implications of these powerful forces at play? Thank you so much for joining us on this deep dive today. We really hope you're leaving feeling well-informed and maybe just a little more curious about the intricate world of finance.
Indeed, understanding these dynamics, these connections, is more crucial than ever. Until next time, keep digging deeper.